Most people think money is real. They think it is paper, coins, numbers in a bank account, a paycheck that arrives every 2 weeks. But money is stranger than that. Money is not valuable because of what it is. Money is valuable because enough people agree to believe in it. And once you understand that one idea, your bank account starts to look different. Your debt starts to look different. Your savings start to look different. Inflation starts to look different. Even the reason working harder does not always make people wealthier starts to make sense. Because money is not just a thing. Money is a system, and most people spend their whole lives inside that system without ever seeing how it actually works. Welcome to Capital Mind. Think clearly about money. Let's start with the simplest question. What is money? Most people would say money is cash, or gold, or dollars, or the number inside a banking app. But those are only forms of money. They are not the idea itself. At its core, money is a shared agreement, a social technology, a way for millions of strangers to trust each other without knowing each other personally. If I give you $1, you accept it because you believe someone else will accept it later. That belief is the real engine, not the paper, not the ink, not the metal, the belief. That is why money can be shells, silver coins, gold bars, paper notes, plastic cards, or digits on a screen. The object changes. The agreement remains. And this is where the first myth breaks. Most people were taught that money came after barter. One person had fish, another had wheat. They traded directly. Then one day, someone invented money to make exchange easier. It sounds clean, but history was never that simple. Long before modern cash, many societies used credit, memory, and records. Someone owed grain, someone owed labor, someone owed silver. Temples, palaces, merchants, and households kept track of who owed what. In other words, money did not begin only as shiny coins in someone's hand. It also began as a record, a promise, a claim on the future. And that matters, because modern money still works that way. $1 in your account is not a gold coin waiting in a vault. It is a claim inside a system, a number everyone agrees to treat as value. Coins made that trust easier to move. Metal was durable, recognizable, harder to fake. A coin could carry value from one place to another. But coins had limits. They were heavy. They were risky to transport. And as trade grew, people needed something lighter. That is where paper money changed everything. Paper money did not begin as magic. It began as convenience. Instead of carrying heavy metal, people could carry a receipt, a note, a claim that represented something valuable stored somewhere else. At first, that made sense. Paper was lighter. Trade moved faster. Trust became easier to transfer. But then something important happened. People slowly stopped treating the paper as a claim on money and started treating the paper itself as money. And once people believed the paper had value, the system became more flexible, but also more dangerous. Because paper is easier to create than gold. And when governments, rulers, or banks discover that money can be created more easily, the temptation never disappears. Wars are expensive. Empires are expensive. Government promises are expensive. And creating more money can feel easier than raising taxes or cutting spending. But when more claims are created than the economy can support, each claim becomes less powerful. That is one way inflation begins. Not always immediately. Not always evenly. But over time, more money chasing the same goods can weaken the value of each unit. And this is where money becomes political. Because whoever influences the creation of money influences more than payments. They influence prices, debt, savings, wages, asset values, and the future purchasing power of ordinary people. Now we get to the part most people never really understand. Banks. Most people think banks work like storage boxes. You deposit money, the bank keeps it safe. Someone else borrows it, and the bank passes money from savers to borrowers. That sounds simple. But modern banking is not that simple. When a bank makes a loan, it does not simply hand you someone else's cash. It creates a new deposit. If a bank approves a loan, the borrower's account is credited. New spending power appears. A new asset appears for the bank. A new liability appears for the borrower. And new money enters the system. In simple terms, the loan creates the money. That does not mean banks can create unlimited money without consequences. They are constrained by regulation, capital, risk, interest rates, central bank policy, and whether borrowers can repay. But the basic idea is still powerful. In the modern economy, a large amount of money is created through lending. Debt creates deposits, loans create money, and repayment destroys money. This is the opposite of how most people imagine the system. They think money comes first, then debt. But often, in the modern financial system, debt creates money first, and that changes everything. A mortgage is not just a home loan. It is new money entering the housing market. A business loan is not just financing. It is spending power created against future production. A credit card balance is not just convenience. It is future income pulled into the present. This is why debt can make an economy grow, but it can also make it fragile, because every loan is a bet on the future, a bet that tomorrow's income will be enough to pay for today's promises. And when too many promises are built on a future that does not arrive, the system starts to shake. Now let's talk about the moment that changed modern money forever. For much of the 20th century, the global monetary system was connected, directly or indirectly, to gold. After World War II, the Bretton Woods system made the US dollar the center of global finance. Other currencies were tied to the dollar, and the dollar was officially convertible into gold for foreign governments. That created discipline, at least in theory. But the United States started spending heavily. War, government programs, global commitments. More dollars existed around the world than the gold system could comfortably support. And in 1971, President Richard Nixon ended the dollar's convertibility into gold. The gold window closed, the old system broke, and the world moved fully into the age of fiat money. Fiat money means money by decree, money backed not by gold in a vault, but by government authority, central banks, productive capacity, taxation, military power, legal systems, and trust. That does not mean fiat money is useless. You can still pay rent with it, buy groceries with it, build companies with it, invest with it. But it does mean its value depends on confidence. Confidence that the government will survive. Confidence that the currency will be accepted. Confidence that inflation will not destroy purchasing power too quickly. Confidence that the system will still work tomorrow. That is the real foundation. Trust. Not gold. Trust. Now here is where ordinary people feel the system most directly. Inflation. Most people think inflation means prices go up, but that is only what people see. The deeper truth is that inflation means the purchasing power of money goes down. A dollar still looks like a dollar. The number does not change. But what it can buy slowly changes. Your savings can sit still and still lose power. $100 today buys only about $12 worth of 1971 purchasing power. The bill still says 100, but the power behind it is mostly gone. That is why inflation is so confusing. Nothing disappears from your bank account. No one breaks into your wallet. But year after year, the same amount of money buys less. The loss is quiet, invisible, almost polite. And modern central banks do not usually aim for zero inflation. They often aim for low, stable inflation. The idea is that low inflation can help the economy avoid deflation, support employment, and keep expectations stable. But for ordinary savers, the result is still clear. Cash is not neutral. Cash is a melting ice cube if it sits too long. Slowly, quietly, predictably. This is why wealthy people think differently about money. They do not only ask, "How much cash do I have?" They ask, "What does this cash become?" Because in a fiat system, holding money is not always the same as preserving value. Money has to move wisely. Into productive skills, into businesses, into investments, into assets, into systems that can grow faster than inflation. This is one reason assets matter so much. Stocks, real estate, businesses, intellectual property, productive tools. These things are not guaranteed to make anyone rich. They can rise and fall. They carry risk, but they have one advantage cash does not always have. They can produce, or appreciate, or participate in growth. Cash stores optionality. Assets can store and create value. That is why the modern financial divide is not only between people who earn more and people who earn less. It is between people who only hold money and people who own systems that benefit when money expands. When credit expands, asset prices often rise. When interest rates fall, borrowing can push prices higher. When inflation runs through the economy, people with assets may be protected better than people with only wages and cash. That is not always fair, but it is how the system often behaves. Now we can connect the whole map. Money began as trust, then records, then coins, then paper claims, then bank deposits, then fiat currency, then digital balances. Today, most money you use is not physical. It is numbers, bank balances, card payments, electronic transfers, credit lines, a financial nervous system moving value across the world at high speed. And that system is powerful. It lets people buy homes before saving the full price. It lets companies expand. It lets governments respond to crises. It lets economies grow faster than they could with only metal coins. But the same system has a cost. It rewards people who understand credit and punishes people who are controlled by it. It helps asset owners and pressures wage earners. It makes spending easy, saving difficult, debt normal, inflation quiet, and financial mistakes expensive. So what should an ordinary person do with this knowledge? Not panic, not fall into conspiracy thinking, not assume every bank, government, or institution is secretly controlling every move. The point is not fear. The point is clarity. Once you understand money as a system, you stop treating your paycheck as the whole game. You start asking better questions. How much of my income becomes margin? How much of my margin becomes assets? How much of my debt is productive? How much of my cash is losing power? How much of my future income have I already promised away? How do I become less dependent on one paycheck? How do I own more of the systems that money flows into? That is the shift. Most people are trained to chase money. But the real game is understanding how money moves. It moves from income to expenses, from borrowers to lenders, from savers to asset owners, from cash to investments, from the uninformed to the informed, from people who react to people who understand. Money is not evil. Money is not fake in a useless way. Money is a tool, but it is a tool built on trust, debt, policy, and belief. And if you do not understand the tool starts using you. You work for money, borrow money, save money, spend money, fear money, chase money, but never stop to ask what money really is. So here is the simplest answer. Money is a claim on value, a memory of trust, a record of debt, a tool of coordination, a political instrument, a psychological force, and a system that only works because enough people believe it will keep working. Once you see that, you stop looking at money like paper. You start seeing the map behind it. And once you see the map, you can finally stop guessing. This is capital mind. Think clearly about money.